You are welcome to my channel today. If this is the first time of you coming across my channel, please don't forget to subscribe so that you don't miss my upcoming videos. In this presentation, I will be examining the planning and operational variances. Planning and operational variances. Planning variances or planning variance arises when planning variance arises whenever you want to correct the level of the forecasting errors inherent in the given variance. Planning variance is used when you want to correct the level of forecasting errors inherent in a given variance. In a planning variance, this concept will be used. We'll be using the concept ex ante. You are comparing ex ante and ex post. In planning variance, you are comparing ex ante with ex post. I will still explain what I mean by ex ante and ex post. This ex ante will be divided into two. I want you to know that both ex ante and ex post, they are standard. So we have the ex ante standard quantity. And remember, I've told you that the standard quantity should always be flexed. So we have based on actual production and standard price. Why ex post should equally be divided into two? Ex post standard quantity based on actual production and standard price. That is ex post. I've told you that in a planning variance, we have the concept of ex ante and ex post. Therefore, to calculate planning variance, you have ex ante minus ex post. Ex ante minus ex post. That is the model or the formula for calculating the planning variance. So what do we mean by ex ante? Ex ante is the original standard. Ex ante is the original standard. That is the first target set. That is ex ante. So ex ante is the first target set. Suppose you want to buy a copy of performance management textbook. Performance management. You want to purchase a performance management textbook. And you were planning the sum of 5,000 naira for the book. So this was your target. And you have set your standard at 5,000 naira. That standard you originally set is called ex ante. This is the ex ante standard price. But before you go to market to purchase the book, so maybe one of your friends paid you visit, and the person told you that he or she made a purchase of performance management textbook maybe 2 days ago, and he was able to get the book for 6,000 naira. That the book is now more expensive than before. So you now revisit your standard. You review your standard, you revise your standard, you alter your initial standard. Notice what's your initial standard called ex ante. You now alter that standard and have a new standard. A new standard you said is called ex post. That is your latter standard. Your latter standard. That is ex post. So now, there are a lot of factors that can make you to alter your initial standard. Maybe you might alter it due to inflation. So that is ex post. Now, when you now have your ex post, you've not gone to the market, but you might now go to market to purchase the book, and you might now have actual. The actual, maybe you actually bought the book for 6,200 naira. This is the actual price it was bought. This is your initial target called ex ante. This is your latter target, which is 6,000, and this is the actual amount it was obtained. So this is S ante and this is S post. I've told you that S ante is the initial target set, while S post is the latter target set, or the latter standard. That is S post. S post is the latter standard. The standard you set later on, that is S post. But the first standard you set is called S ante. To compute material price planning variance, material price planning variance. Remember, I've told you that you want to compare the ex ante with ex post. Under the basic variance we've considered, we said material price variance. Under the basic variance, material price variance, we said is equal to standard price minus actual price multiplied by actual quantity. Remember, I've told you that in planning variance, you want to compare ex ante. Ex ante. That means what you need here is ex ante standard price. This one, since you are comparing ex ante with ex post, this will be ex post standard price, not actual price. Instead of actual quantity here, since this actual price has changed to actual S post, then the weight here, instead of actual quantity, it will be S post standard quantity based on actual production. Instead of actual quantity, you are now replacing that with S post standard quantity based on actual production. Therefore, material price planning variance equal to ex ante standard price, ex ante standard price minus ex post standard price. Remember, I've told you that you are comparing ex ante with ex post in planning variance. Multiply by ex post standard quantity, ex post standard quantity based on actual production. 2. Material usage operational planning variance. Material usage planning variance. Material usage planning variance. Under the basic or traditional variance, we say material usage variance equal to standard quantity based on actual production minus actual quantity multiplied by the standard price. So, this, remember, you are comparing ex ante with ex post. So this one becomes ex ante standard quantity based on actual production. This one will become ex post standard quantity based on actual production. Since this one is changing to ex post, this one become, this one too. This one will now become x, since it is standard, this is standard. And our standard here retains S ante multiplied by X ante standard price. Therefore, material usage planning variance becomes X ante standard quantity, X ante standard quantity based on actual production minus S post standard quantity, S post standard quantity based on actual production multiplied by S ante standard price. That is material usage planning variance. So now we want to consider labor variances, the planning variances for labor. For labor planning variance, remember I've told you in planning variance you are comparing ex ante with ex post. For labor we have standard hours based on actual production and we equally have standard rate. So here we have standard hours based on actual production and standard rate. So labor rate planning variance now. Labor rate planning variance if planning variance is x ante minus x post. So under the traditional variance, we say labor rate variance equal to standard rate minus actual rate multiplied by actual hours. So this one, the standard rate here become x ante. So that means we have x ante standard rate. Here we have x post standard rate, not actual rate. Then actual hours now. So this is actual rate, this is actual hour. These two goes together. So that means this one become x post standard hour. X post standard hour based on actual production. Therefore, labor rate planning variance becomes x ante standard rate minus x post standard rate multiplied by x post standard hours based on actual production. Then we equally have labor efficiency variance. Labor efficiency planning variance. Remember the concept S ante and S post will be used. Then we have under the basic variance, we say labor efficiency variance equal to standard hours based on actual production minus actual hours multiplied by the standard rate. So this one becomes X ante now. Standard hour based on actual production. This one now become X post standard hours based on actual production. Standard hour based on actual production. Then standard rate here. Standard. So and the standard here is S ante. So that means the standard rate here become X ante standard rate. So the formula for labor efficiency planning variance, we have X ante standard hours based on actual production minus X post standard hour based on actual production multiplied by X ante standard rate. These are the formula for calculating planning variance. I therefore want to consider the operational variance. Operational variance is designed to measure the actual level of efficiency based on the newly established standard. Operational variance is designed to measure the actual level of efficiency based on the newly established standard. In operational variance, you want to compare X post with actual. That is operational variance equal to X post minus actual. That is operational. This X post for material, you can have X post standard quantity based on actual production and X post standard price. Then actual, you have actual quantity and actual price. So you want to compare the X post with actual. That means operational variance equals to X post minus actual. X post minus actual equal to operational variance. Therefore, if you are to compute material price, operational variance, material price, operational variance, material price, operational variance. Under the basic variance, we say material price variance equal to standard price minus actual price multiplied by actual quantity of material purchased. So since you are comparing ex-post with actual, that means this one becomes ex-post standard price, and this is actual. That means you are going to retain actual, and this is also actual, so you leave it. So that means the formula becomes ex-post standard price minus actual price multiplied by actual quantity. That is material price operational variance. To compute material usage operational variance, material usage operational variance. Under the basic or traditional variance, we say material usage variance. We say it's standard quantity based on actual production minus actual quantity multiplied by the standard price. So that means this standard become ex post standard price. This is actual, so you will still leave it as actual. This is standard price, it become ex post standard price. So material usage operational variance will now be ex post standard quantity based on actual production minus actual quantity multiplied by ex post standard price. Ex post standard price. That is material usage operational variance. So we want to consider the labor variances, labor operational variances. So remember, operational variance, you are comparing ex post with actual. So, and in labor, we use hours and rate. So the ex post now, that means the ex post, we have ex post standard hour based on actual production and the standard rate. The actual, we have actual hour and actual rate. So labor rate operational variance. Labor rate operational variance. Under the basic or traditional variance, we say labor rate variance, we say it's standard rate minus actual rate multiplied by actual hours. This standard rate becomes ex post standard rate. Actual rate will remain. Actual hour will remain. So we have the formula as ex post standard rate minus actual rate multiplied by actual hours. Actual hours worked. Number 2, we have labor efficiency operational variance. So we've examined labor efficiency variance under the basic variance. We said it's standard hour based on actual production minus actual hours worked multiplied by standard rate. So that means the standard here becomes ex post standard hour based on actual production, and the standard rate becomes ex post standard rate. So the formula becomes ex post standard hour based on actual production minus actual hours multiplied by ex post standard rate. That is the formula for calculating labor efficiency operational variance. Having considered the formula for calculating the planning and operational variances, I therefore want to take a work example. Example: LASICO has produced the following operating statements reconciling budgeted and actual gross profit for the last 3 months based on actual sales of 122,000 units of its single product. Operating statement, amount in naira. We have budgeted gross profit 800,000 naira. Budgeted fees, production overheads 352,000 naira. Budgeted contribution of 1,152,000 naira. Sales volume contribution variance 19,200. Sales price variance 61,000. The net difference is 41,800. Actual sales less standard variable cost of sales 1,110,200. We have planning variances. We have the favorable and adverse. Variable cost variance, which include direct material price. We have adverse variance of 23,991. That is direct material price planning variance 23,991. Direct material usage 42,090. No, this is direct material usage planning variance 42,090. Direct labor rate 81,333, which is direct labor rate planning variance, and that is the amount. Direct labor efficiency planning variance of 203,350. The total favorable variance is 42,090, while the sum of all the adverse variances we have 308,674. The net difference between the favorable and adverse variance we have 266,584. Operational variances. We have variable cost variances, favorable variances, and adverse variances. We have direct material price. That is direct material price operational variance. We have 31,086. Direct material usage operational variance 14,451. Direct labor rate operational variance 19,032. Direct labor efficiency operational variance 135,355. The sum of all the favorable variances is 149,806, while the sum of the adverse variances we have 50,118. The net difference between favorable and adverse variances is 99,688. Then we have actual contribution of 943,304. Budgeted fixed production overheads we have 352,000. Fixed production overheads expenditure variance we have 27,000. Then actual fixed production overheads 325,000. Then actual gross profit 618,304. The standard direct cost and selling price applied during the 3 months period, and the actual direct cost and selling price for the period were as follows. We have the standard and actual. We have selling price naira per unit. The standard is 31.50, while actual is 31 naira. Then direct material usage kilogram per unit 3.00 for standard, and the actual is 2.80. Then we have direct material price naira per kilogram 2.30 and 2.46 for standard and actual respectively. Direct labor efficiency hours per unit 1.25 and 1.30. Direct labor rate naira per hour 12 naira and 12.60. After the end of the 3 months period and prior to the preparation of the above operating statement, it was decided to revise the standard cost retrospectively to take account of the following. Number 1, a 3% increase in direct material price per kilogram. 2, a labor rate increase of 4%. 3, the standard for labor efficiency had anticipated buying a new machine, leading to a 10% decrease in labor hours. Instead of buying a new machine, existing machine had been improved, giving an expected 5% saving in material usage required. A, using the information provided, demonstrates how each planning and operational variance in the operating statement has been calculated. B, calculate direct labor and direct material variances based on the standard cost data applied during the 3 months ended. So that is the question. This question is obtained from Workout Performance Management by Omolenwa. Now let's have the solution. Solution. We have actual have ex post. Ex post standard. I've told you that ex posts are standard. There's nothing like ex post actual. Then we also have ex ante. I've told you that all ex ante are also standard. Let's have ex ante standard. Now, if you go back to the question, by theory, then direct material price naira per kg 2.30 and 2.46 for standard and actual respectively. 2.30 for standard and actual we have 2.46. 2.46. Then the next item is direct labor efficiency, hour per unit. Now let's have direct labor efficiency, hours per unit. You are given selling price naira per unit, direct material usage kilogram per unit 3 naira at 2.80. Now let's have direct material usage, and you were given that to be in kilogram per unit. The standard is 3 and the actual is 2.80. The standard is 3 and actual is 2.80. Then we also have direct material price naira per kilogram. Direct material price, and this is in naira per kg. Direct material price 2.30 and 2.46 for standard and actual respectively. 2.30 for standard and actual we have 2.46. 2.46. Then the next item is direct labor efficiency, hour per unit. Now let's have direct labor efficiency, hours per unit. 1.25 for standard and actual is 1.30. 1.25 for standard, actual we have 1.30. Then we also have direct labor rate naira per hour. Direct labor rate naira per hour. Direct labor rate naira per hour we have 12 and 12.60. The standard is 12.00, the actual is 12.60. These are the initial standard. I've told you that the initial standard says that is called ex ante. So now, maybe due to some circumstances, you have to alter your earlier standard. When you alter your earlier standard, a new standard will be set. The latter standard set, that is called ex post. Now let's go through the question. After the end of the 3 months period and prior to the preparation of the above operating statement, it was decided to revise the standard. Notice are the initial standard. You now want to revise those standards, to revise the standard cost retrospectively, to take account of, you want to revise the standard, to take account of the following. So when you revise it now, in order to take account for this, so the new standard forms, that standard is called ex post. Now, a 3% increase in direct material price per kilogram. You know, initial, when we say percentage increase, initial amount, the original amount is 100%. So if it now increased by 3%, then you add 3% to 100%, then you have 103%. A 3% increase in direct material. So now, where is the direct material price? The standard was 2.3. When if it increased by 3%, you add 3 to 100, you have 103% of 2.30. Then you have 103% of 2.3. Then your expo standard will now be 2.369. This is our expo standard price. Now, back to the question. Note 2. A labor rate increase of 4%. A labor rate, if it increases by 4%, that means you add 4 to 100, then you have 104%. How much was the labor rate before? Direct labor rate was 12. If it increases by 4%, you have 104%. 104% of 12 naira. So that gives us 104 divided by 100 times 12. That gives us 12 naira 48 kobo. 12 naira 48 kobo. Therefore, S and S post, this is S post now. S post standard rate is 12.48. This is S and T standard rate, 12 naira, while actual rate is 12.6. Back to the question. Note 3. The standard for labor efficiency had anticipated buying a new machine leading to a 10% decrease in labor hours. So efficiency of labor, it decreases. That means if it decreases by 10%, the standard efficiency will be 90%. So you now want to calculate what the actual efficiency ought to have been. If it decreases by 10%, you subtract 10% from 100, then you'll be left with 90%. That means this standard efficiency, 1.25. Efficiency of labor is measured in hour, 1.25. That is standard. Then the actual now, that means your efficiency now ought to have been 1.25 divided by 0.9. That is 90%. You can see 1.25 divided by 90 times 100. You want to cross it up to 100%. So 1.25 divided by 0.9. Then you have 1.3889. This is the exposed standard hours per unit. So that is for that. Instead of buying a new machine, existing machine had been improved, giving an expected 5% savings in material usage. 5% savings means the material usage reduces by 5% as a result of what? As a result of the improvement of the existing machine. When the existing machine improved, then it saves the material wastages. The usages of material reduces by 5%. That means you'll be having 95% if you subtract 5 from 100. So you'll be left with 95%. So material usage now will be 95% of 3 kg. So 95% of 3 kg, that gives us 2.85. 2.85. That is the ex-post standard hours. So we've computed the ex-post now. Now let's go into the full solution. In the requirement A, using the information provided, demonstrate how each planning and operational variances in the operating statement has been calculated. I've told you that when calculating planning variance, you are going to compare ex ante with ex post. I've told you that ex ante standard price, you have been given the ex ante standard price, ex ante standard quantity, ex ante standard quantity based on actual production. I've told you that you have to replace your standard quantity based on actual production. Now, what is our standard quantity? For direct material usage, kg per unit, ex ante is 3. So have 3 times what is our actual production? Back to the question. You were told that LASICO has produced the following operating statement, reconciling the budgeted and actual gross profit for the last 3 months based on actual sales of 122,000 units. You were given the actual sales of 122,000 units, and production was not given, actual production was not given, and you are not given the level of inventory, since no inventory of items were given. So that means the units produced is assumed to be equal the units sold, since there is no inventory. All units produced were sold. So in that case, our units sold will be assumed to be the units produced. But if you are given the level of inventory, you add the closing inventory, you minus the opening inventory in order to get the number of units produced. But in this case, we are assuming our sales to be the units produced. So the actual production is 122,000 units. So we have 3 times 122,000. So that will be 366,000. 3 times 122,000. That will be 366,000 kg. That is our ex ante standard quantity based on actual production. Then ex post standard quantity based on actual production. That will be our ex post direct material usage. Ex post standard quantity is 2.85. Direct material usage kg per unit 2.85. That is ex post. So we have 2.85 times actual production of 122,000 units. Remember, I told you that sales and production are the same, since production are not given. So we have 2.85 times 122,000. That gives us 347,700 kg. That is our ex post standard quantity. So what is the ex ante standard hours based on actual production for the purpose of labor variance? Ex ante standard hour. You are given direct labor efficiency hour per unit. Ex ante is 1.25. So we have 1.25 multiplied by the unit sold. Actually, that unit sold is the same as unit produced. 1.25 times 122,000. That gives us 152,500 hours. Exposed standard hour based on actual production. The exposed standard hour, direct labor efficiency. Exposed is 1.3889. 1.3889 times 122,000. That gives us 1.3889 times 122,000. So we have 169,000. 446 hours. Now, we want to calculate the planning variance. We want to calculate direct material price planning variance. How they will arrive at 23,991. So that is what we want to calculate now. Direct material price planning variance. I've told you that to compute any of the planning variance, We want to compare the S and T with S post. Therefore, direct material price planning variance equals to X and T standard price minus X post standard price multiplied by X post standard quantity based on actual production. Our S and T standard price for direct material, we are given direct material price naira per kg. S and T is 2.3, while S post is 2.369. S and T is 2.3, S post is 2.369. So we have the S and T is 2.30 minus S post is 2.369 multiplied by S post standard quantity. Our S post standard quantity based on actual production has been calculated, and we got 347,700 kg. 347,700 kg. So what is the, you have 2.3 minus 2.369, the difference is 0.069 times 347,700. So we have 23,000. Therefore, direct material price planning variance, we got 23,991 naira. That is an adverse variance. Adverse. So that is direct material price planning variance. That is how they've arrived at 23,991. So we've gotten this. Now, we want to compute direct material usage. How they've arrived at 42,090.